Okay, let's take this thing apart. Current assets. We talked about this a little bit. Cash, accounts receivable, inventory. Current, because I expect every one of these to turn into cash within 12 months. Cash is already cash. I hope to collect on my accounts receivables within 12 months. I hope to use my inventory within 12 months. Long-term assets, that's where I put my equipment. Improvements to my real estate and things. Oh, by the way, now look at this. Net of depreciation. What in the world is that? Oh my goodness. Remember my truck? $10,000? That's a thing I have. So right, that's a piece of equipment. We'll call it equipment and trucks. So I got $10,000 of equipment. But I was able to have a $2,000 depreciation expense against it. Okay? So I go $10,000 minus $2,000, that's $8,000. Okay? My truck is now worth $8,000 at the end of the first year. It's worth $6,000 at the end of the second year, $4,000, $2,000. At the end of the fifth year, it says my truck is worth $0. Because I have $10,000 of asset, I have $10,000 of depreciation.
So what happens if you're still using your truck?
You go, well, first of all, you're still allowed to drive your truck. No one, the accounting rules don't prevent us from driving or using the assets. I know that's not what you meant, but it's a good point. Well, that's when we get to book value and market value. It has a book value of 0. My truck is worth a lot more than 0.
It's moving my
stuff around, and frankly, I could put it on Craigslist and get $5,000 for it. So the market value is different than book value. It's too much to talk about now, and some of it, to talk about in detail, it would be beyond me. But one of the reasons we set those rules up is so that companies account for the value of their equipment in similar ways. We don't have to go back too many years to Enron to understand that Enron counted their things in a way that's different the way most people get it. If you want to make an investment between two companies, company A and company B, and you looked at their balance sheet, you'd want to know, you don't know what condition their trucks are in. One guy never washed his and never changed oil, and the other guy parked it indoors and treated it like his child. So the market value is going to be different. You'd have to go and check that out to see that. But you'd want to know if you're just looking at their accounting statements that they counted the numbers the same way. You don't want people making up the rules for how they're going to decide what the book value is, or I can't compare company A to B anymore because everybody's rules could be. And we've got examples of companies who kind of did a little bit of that historically and got in trouble. Okay? And then we have intangible assets. We could have also patents and other things that fall into that category. I'm not going to say much about those. But that's assets, current and long term. Okay? Liabilities. Well, liabilities is debt, right? Debt. Money we owe to other people. Accounts payable is a debt. It's a loan from my supplier. It's a loan from my supplier. So it's debt. All right? And I better pay it within 12 months or I'm going to have an unhappy supplier. Deposit, customer deposits. You ever think about that? Customer pays me a deposit for, let's say we agree, I'm going to do your job for you, but I require a down payment. The down payment is, I don't know, $2,000. It's a $10,000 job and I need $2,000 down payment before I start. So I put that $2,000, give it to my bookkeeper, and he or she deposits it in the bank and books it in my QuickBooks, and it shows up as a liability, a current liability. Wait a minute, it's money. I thought that was good. I thought that was stuff I had. Wait a minute. Why would it be a liability? Why would it be a liability? Bingo. Because I haven't earned it yet. Exactly right. I haven't earned it. So if I don't finish a job, or if I do, now once I get up to $2,000, I don't have to count it as a liability anymore. Okay? Because I've earned it. Now it could be a receivable, conceivable. But until that point, I really owe that back to my customer. Perfect. Great answer. Line of credit. Line of credit's a loan you get from the bank. The reason it's a current liability is it's a revolving 12-month note. In almost all cases, it's a 12-month loan. 12 months or less, current. All people, you know, they have line of credit and they don't know that. You know, now what happens at the end of the year, the banker calls you up and says, hey, Christmas, got that can of cashews for you, want to just come over and give you the cashews, and by the way, we got a little paperwork we got to sign. And then, you know, but you're all giddy about the cashews and you signed the paper. Well, you just renewed your line of credit. You just signed up for another 12 months. You just took out a new loan for the next 12 months, and that's generally the way it works.
And that line of credit is there regardless if you utilize it or not. Let's say it's a $50,000 line of credit. It goes there whether you use that or not?
No,
Just if you use
it's
it.
your outstanding balance.
Okay.
So if you've got
It's
100,
yours, you use, yeah.
if you've got a $100,000 line of credit, you're using 10 shows up there,
Okay.
because that's the obligation
And
back.
that's what I thought, but how you were positioning it.
Yeah, yeah.
Okay.
Yeah.
No money changed hands. Yeah.
No, you're right. In the line of credit, no money changed hands. And most, you know, at the end of the note, you're supposed to pay the bank back. But usually, they don't ask for the money back. They could ask for it back. They're entitled to ask for it back, but they typically don't. If they're happy with you, they say, you know, we'll just start the new year off with you owing me $10,000 like you finished the last year. So those revolving notes tend to just continue to revolve.
Explain again, I don't understand.
Understand what?
What a line of credit is. Is it money that's borrowed
It's-
or
it's
is
a-
it
it's
the
a loan.
amount of money you could borrow?
It's the amount of money you borrow.
It's like if you have a credit card that
It's a-
you can spend $10,000 on your account and you buy something on it for $5,000,
Only the 5 would show up.
$5,000.
It's how much you owe someone, and because it's current, it's a short-term, like your credit card. Got it. And then long-term liabilities, loans, bonds, which are forms of loans. Sometimes you'll see current portion of long-term debt. If you see that, what it means is it's the portion of these loans that have to be paid in 12 months, in the next 12 months. Sometimes you'll see that, so don't let that kind of throw you off. Okay?
Can I make a quick comment?
Yes?
Sometimes the mistake that business owners make is they use their lines of credit to acquire long-term assets. And so then they have a short-term liability funding a long-term asset. And so they're mismatching on their balance sheet.
Yeah, there's, great point, Laura, thanks. It's just kind of this general rule of thumb, and I don't have a slide here for it, but, you know, short-term loan, short-term needs, long-term loan, long-term needs. So, you know, why do you, and I don't want to dwell on line of credit because I want to keep moving here, but line of credit is designed to kind of smooth out the ups and downs of business. I got to make payroll, but the checks from my customers not coming until next week. You know, we all deal with that all the time. So how do I smooth that out? Well, wouldn't it be great if I could just borrow a little bit of money, use it, pay it back next week, borrow a little bit, pay it back next week. Well, if I go out and buy a truck and I use this kind of slush fund that the bank has set up for me to buy my truck, and then now next week I have to do payroll, well, that's going to be tough. What am I going to do? Go to the bank and say, give me a 5-year term note to make payroll? They say, well, no, you should have done that for your truck, so you left the money, you know, so the money should be used what it was intended for. Short-term money, short-term needs. Long-term money, long-term needs. Or you get into those situations where, now what do? I've used up my short-term money, I have a short-term need. That happens all too often, unfortunately. Equity, the last section. Equity. Capital investment, what you put into the business. So if you were looking at IBM or you're looking at General Motors, you're going to see common stock there. But what is common stock? It's the investment of the owners. It's what the people who purchase the stock put in. Now, I mean, their numbers are big numbers, lots of dollar value there. Okay? That's what it is. Our values are small, their values are big, but it's the same thing. Okay? Sometimes you'll see a line called additional paid-in capital. Typically, where I see additional paid-in capital is, I'll see capital investment and additional paid-in capital. Capital investment is usually the initial capital investment, and additional paid-in capital is investment that owners put in after the initial investment has been made. Maybe it could be years later that that's done. Okay? Remember, this isn't money people are loaning. This is money owners claim for themselves. Could have been their investment. And then here's the retained earnings. This is their profit. This is their profit, but remember that profit actually lives in some asset. It lives in my checking account as U.S. currency. It lives in my garage as a truck. It lives in my plant as a machine. That's where retained earnings is. Now, if you think about the balance sheet, assets equals liabilities plus equity. Let's go back to our home example. My $100,000 home equals the $80,000 mortgage plus my $20,000 of equity. Okay? Asset equals loan plus equity. Assets equal liability plus equity. And if you just keep that mortgage model in your head, you understand the balance sheet. You can figure out a balance sheet from there. It's that easy.